HDFC Limited has gone ahead and released their FY29 annual report, and I bring in the key highlights from the chairman's letter, which is Mr. Deepak Parekh. Mr. Parekh states that working remotely called for a reorientation of mindset, systems and processes, and during FY21, HDFC Limited has further fortified their balance sheet through capital raise. Second half of FY21 only reaffirmed the belief that more than ever before, people are craving for homes. Demand was there for affordable housing as well as high-end properties. Demand also came in from first-time home borrowers, from borrowers who are moving up the property ladder into larger homes or even relocating. Speaking about the impact of the second wave, he stated that the second wave impact on the economy is less than the first wave. As is the case globally, recovery is likely to remain patchy and uneven. And I quote him that I do believe that the second wave of infections in India could have less impact on the economy than the first wave. Since the outbreak of the pandemic, despite the disruptions, the Indian financial system and capital markets have displayed remarkable resilience, and kudos must be given to the regulators, which is both the Reserve Bank of India as well as the SEBI, who have consistently been responsive to the needs of the economy. Mr. Parekh also stated that he was speaking about ironing off some of the regulatory wrinkles, and herein he has called up for the attention that banks and insurance companies have not migrated to Ind AS, but it has been 3 years that NBFCs have migrated to Ind AS. This isn't really a level playing field. In fact, he goes on to state that it may be prudent to at least resolve these open-ended issues sooner than later. Another niggling point for the HFCs is retention of customers, wherein he calls upon the attention that the issue is that onboarding of a home loan customer takes a great deal of effort and entails cost as well, but certainly an endeavor to retain a performing customer, which could entail a change in the rate of interest, is not akin to a loan being restructured, and it would be of great comfort for all HFCs to have this issue put to rest. In fact, he also stated that the current environment has proved that there is no better protection for a borrower than home loan insurance and home insurance, and herein that he states that given the risks around climate change and abrupt weather patterns, home insurance becomes a key risk mitigant. Currently, an insurance loan given to a home loan borrower is considered as a non-housing loan. Insurance is voluntary for a home loan borrower, but the reality is that the insurance loan to the home loan customer should be considered as an integral component of a housing loan and be permitted to be classified accordingly. After all, insurance protects both the customer as well as the HFC. And Mr. Parekh states that the last submission is that the regulatory framework in its current form may have the unintended consequence of penalizing an HFC for maintaining excess liquidity. Large amounts of liquidity are being held by HFCs out of abundant precaution, but surely maintenance of high liquidity should not become the hindering factor, leading HFCs to have to recalibrate their housing and non-housing portfolios so as to meet the prescribed minimum threshold limits of assets in housing finance. A minor tweak which could exclude surplus liquid balances from total assets to arrive at prescribed limits will go a long way in helping HFCs, says Mr. Parekh. Thank you for watching.